My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends, just trying to make a little money. My job is not to entertain, but to educate. Well, I do a little entertaining. Come on, let's get it together. Call me, 1-800-743-CNBC. Tweet me, Jim Cramer. Yes, I am excited about this market. And I'll tell you why. It's not just because we've now had 8 straight days of up. 20 years today, Google came public at a split, unadjusted price of $85 a share. On its first day, Google closed up 18%. Many traders, they thrilled at the pop. They took the gain. In retrospect, one of the greatest mistakes of all time. Do you know that Google stock is now giving you a 7,736% return versus the S&P 500 slightly more than 600% with dividends? It's a reminder of the wealth individual stocks can make for you, can give you versus the indices when you pick the right one. And I'm telling you, they're not all that hard. Did you know how to Google? So I think it's time to defrock the average, at least for a day, okay? Even if it was another good day for them, with Dow gained 237 points, S&P jumped 0.97%, NASDAQ folded 1.39%. Specifically, we need to talk about the short term of the market versus the long term of the stocks. The short term setup's not so good. We're on a real winning streak here, as I mentioned, 8 straight days up, the longest since November of last year. 93% of the stocks, the S&P 500, are up, truly impressive. All since that Monday where the market fell apart because of the yen carry trade. It imploded and led to a wave of forced selling in this country, sell, which in turn caused people to panic. Hey, how many times have I told you panic's not a strategy? We've been pretty much straight up since that panic. Unfortunately, the market gets a little perilous when we're what I call overbought. Now, I measure overbought with the trusty Market Edge oscillator. Same one I've used since 1987. Do you know it's never let me down? The oscillator is a baseline of 0, meaning the market's in neutral territory. When it goes to -5 or lower, well, guess what? You have to buy because we are oversold, meaning there's too much downside pressure. When it goes to +5 or higher, you got to sell something. Today, after the close, we learned that the oscillator was a very overheated 7.26. Way too hot for this guy. So we've been raising some cash for the charitable trust, mainly by taking losses. You got to subsidize the winners with the losers. You can't do the opposite. Painful, but necessary, and more on that later. When the market goes up in a straight line like this, you end up in what I call a fraught situation. That's why we need to be a little more defensive. Because when the oscillator reaches overbought levels like now, the next move is almost always down. That's the short term, though. What about the long term? Unfortunately, they are very cross purposes right now. On this, the 20th anniversary of the IPO, I want you to consider the saga that is Google, because I like the saga so much. It makes me happy. When it came public, it did so via called a Dutch auction system, which favored the buyers over the sellers. You got a terrific price if you managed to snag a piece of it. I remember mentioning on air that I thought that Google was worth about $300 that day, a price so high that our lawyer called me in to ask me how I came up with that number. I said I would have used $500, but I was being conservative. The problem for so many investors is the crossovers we find ourselves in right now. When the market is overbought, you don't want to find yourself owning too much stock. But at the same time, you don't want to give up on a great long-term winner because of short-term pain. We own Alphabet's successor to Google for the trust, and frankly, we don't really care for it. But we don't care for it in the current iteration. We didn't like the success of the Justice Department's lawsuit against the company as a monopolist. We don't like they never talk about their triumphs like YouTube or Google Cloud. We have no idea how well the NFL package is doing. We can't be sure that Google's base search platform won't be usurped by the various artificial intelligence bots like Meta AI, my favorite. We fear the next Justice Department case, which calls into question Google's ability to be on both sides of an advertising exchange. Something that made these guys fortunes, leaving the advertisers, some people think, in the dark. That's what the Justice Department says. A win by Justice would be a devastating blow for Alphabet, worse than the loss over the payment to Apple to be the default search engine, the one that earned them the title monopolist. Plus, it seems that every time management speaks on a quarter, there are new wrinkles that we don't like. But the stock's been a huge winner for us. I mean, huge. We've owned it through the travails of the last year and the year before that, and even before that, and I imagine we'll keep owning it. Why? Because ever since Google came public, it's been able to reinvent itself repeatedly. Originally, it had no cloud business. Then in 2019, Thomas Kurian came in, took over the reins. I knew him, his reputation as brilliant, an amazing operator. He told me he'd have a big cloud business fairly shortly. He seemed to think I'd laugh at that projection, but I didn't, because that's Google, always coming up with something new. Sure enough, 5 years later, Google Cloud Platform is on a $42 billion run rate. The unbelievably fabulous reports moving from her CFO job, now going full-time as president and chief investment officer. What happens when she leaves the job? Well, how about they go ahead and hire Anat Ashkenazi, the incredible CFO of Eli Lilly. A brilliant pickup. This is what Google does. Against this, we have the short-term possibility of a squall that will make people sell the stock because they refuse to take the pain. They can't take the pain. So many investors want to avoid the next downdraft that you almost never see anyone with anything like the 7,736% gain that Google's given you since it came public. This tug of war is a microcosm of the entire market. For example, NVIDIA just had its biggest week in ages, up 19%. I expect this short-term peak. But what happens? This morning, Goldman Sachs reiterates its buy rating, saying it sees a compelling risk-reward going into NVIDIA's earnings next week. So the stock closes up $5 or 4.35%. I'd love to take profits for the trust in the overbought moment, but individual stocks are the true vehicles of wealth creation in this country, not the S&P 500, which is why I'm less willing to lighten up on the best operators. And NVIDIA, despite all the sturm and drang about the stock, is an amazing operator. Same with Amazon. People hated the last quarter. Lots of chatter about a tapped-out consumer. Today, Morgan Stanley comes out and says there's hope for same-day consumable sales. They're going to change their habit forming wildly. Next thing you know, Amazon's making comebacks up 18 points from where it fell after the so-called bad quarter. Microsoft up 3. No particular reason, but I bet you we find out tomorrow why. We also got a hugely positive note from Melius about how markets ignoring Apple's bountiful cash flow. We had another firm talk about the stock's expensive, and it is, unless you consider the cash flow, not the earnings. The Melius piece, penned by the irrepressible Ben Rice, made so much sense that you know you need to strap yourself to the mast so you don't feel compelled to sell your Apple stock when the market gets overbought with an overbought sell, gets overbought as it is now. You see where I'm going with this? The tech titans, the hyperscalers, the colossus portion of the market. Yes, the mega stocks. They just bite you every time you sell. But the short term says sell. To me, that means it's time to get into the bunker and accept the acceptable losses that you can't avoid. These stocks are just too good to let go. Bottom line, as we go into the possible maelstrom, and I'm giving you that, I need you to remember the return if you bought Google 20 years ago. I'm going to say it again. An incredible 7,735% gain that came from a mega cap stock, not from the index. A gain almost no one captured in its entirety. Why? Because they rang the register too often on the way up. When you're dealing with truly great companies, not the indices, but the companies themselves, I sing the praises of. The real risk is that you panic and get shaken out. I challenge you to be able to handle it. Let's go to Lori in Pennsylvania. Lori.
Hi, Jim. How are you?
I am good, Lori. How about you?
I am well, thank you. Before I ask my question, I just wanted to say thank you for everything you do. You really help us little guys out, and we appreciate it a lot.
Thank you very much. Thank you.
Yeah.
Thank you.
So you're welcome. I wanted to ask you, we have Kellanova from the spinoff, and I'm trying to figure out what to replace it with. We're going to hold on to it until Mars buys out, but I can't figure out what to replace it with.
You just take the gain. Just take the gain. Move on. It's a great win. A lot of people didn't have it. Lego my ego. I knew the guy who helped test that thing. I always thought it was crazy. And that was now 40 years ago. It was one of the biggest winners of all time. Can you believe it? Let's go to Robert in New York. Robert.
Hey, Jim. How's everything going?
Not bad, Robert. How about you?
Good. Pretty good, Jim. If you recall, I sang happy birthday on your show to myself. And I was pretty good, but you said don't quit my day job.
No,
so I didn't quit
I
my
know.
Day job.
You didn't quit You didn't quit it, did you?
I didn't. You know what I did? I went out and I bought a dog for my birthday, okay? And I was going to call it NVIDIA after your dog, but I didn't want to do that because I didn't want to copy you. So I called the dog Cramer. I called the dog. The dog's name is Cramer. It's a small little dog. And I was able to buy that dog because you made me money in the market, okay? But anyway, so I went to different stores, pet stores. Nothing really intrigued me, overpriced. So I started seeing all these boxes in all these apartment buildings of Chewy. And I knew I owned the stock. And I got to tell you, the stock has been moving up like 22%. And if you recall, you recommended this stock a while ago and said, this is a good one.
I'm
great
at
CEO.
$19. I was
I
eating
know,
my
and I
Blue
bought it at
Buffalo. I just
19.
had my Blue Buffalo dinner when I did that. That stuff tastes good. I don't know if you use it. It's got an American flag on it, too. You can eat the American flag. I like Chewy. I think it's going to higher. I think it goes to the 30s. And I got to tell you, I like this Farmer's Dog thing. It's a treat. I use it on weekends with my tomato sauce that I make on Twitter. You can check it. All right, anyway, happy anniversary, Google. I love pointing this stuff out. And thank you for reminding us of the wealth we can gain, not from the indices, but from individual stocks that you and I all know because we Googled every day of our lives. You just need the willpower to stick with it. Man, by tonight, Palo Alto's on the move after the report. I'm sitting down with the CEO for post-earnings exclusive. Then I'm digging into a company whose shares are up a whopping 700% over the past 2 years. Probably never heard of it. Oh, yeah, S&P. I'll reveal the name and whether now may be the time to buy. Hey, listen, Cardinal Health's coming on. They lost one of the largest customers in April. Didn't even blink. What a great CEO. I'm going to talk to him. I want you to stay with the Farmer's Dog, Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
About 6 months ago, we checked in with Cardinal Health, one of the 3 big drug distributors in America. Some people call them pharmaceutical middlemen. They're more than middlemen. And I thought they told a pretty good story, frankly. Since then, though, we've learned that Cardinal's second largest customer, that's Optum Rx, wouldn't be renewing their contract, something that initially sent the stock down 5% in a single session. Now, that's suboptimal. However, when the company reported last week, they delivered an 11-cent earnings beat off a $1.73 basis with meaningfully higher than expected revenue, and I think lasting, up 12% year over year. Even better, management extraordinarily raised the full-year earnings forecast for 2025 fiscal year, which just started for these guys. I think it's pretty impressive. So what do we make of this one? Let's dig deep with Jason Holler. He's the CEO of Cardinal Health. Get a better sense of the business. Mr. Holler, welcome back to Mad Money.
It's great to be here, Jim. Nice to see you.
All right, so Jason, a lot of people counted you out when you lost that Optum Rx business, but you have a better, I'd say, more stable mosaic. And I want you to tell people how you could come back within the quarter from such a stunning blow, because you really did have a great upside surprise.
Oh, yeah, we had a really strong finish to a really strong year is what it comes down to. And it's very broad-based across our enterprise. Our earnings per share increased by 29% in both the quarter as well as the full year. And that's on top of strong growth in the prior year. So if you step back and look at our 2-year earnings growth, that's nearly 50% over the last 2 years. And with that, nearly $7 billion of adjusted free cash flow. So the earnings growth has been strong. And like I said, it was across the enterprise. And you know, the size of our pharma segment is by far the largest piece of our enterprise. So you have to start there. Strong, resilient growth over the last couple of years. We finished this last year, 8% growth in the fourth quarter, similar growth for the full year. And we expect to continue to grow the earnings of the pharma segment 1 to 3% next year. But when you look at the year-over-year earnings growth, there's actually more of the GMPD, our global medical products and distribution business. That was a $240 million earnings growth year over year. And that was driven by the inflation mitigation actions that we put in place a couple of years ago. That was $300 million of net inflation we've now mitigated. We exited fiscal 24, having that behind us. And then we have some smaller growth businesses that still aggregate to $4 billion and nearly 10% margins that exited the year double-digit growth, and we've guided for double-digit growth into the future. Okay, so we have a plan, we're executing it, and we're going for it.
The GMPD, that's the global medical, I keep being drawn to that. Now, I shouldn't be because it's not the biggest business, but you just went over it. And I think the inflation and global supply chain constraints, no one else is focused on that. You've got a growth target, $300 million. I mean, you're talking about an area of business that I shouldn't be focused on, but I'm drawn to because I think it could be a margin explosion.
Yeah, so we were losing money the last couple of years. Fiscal 24 was an inflection point, and that was because the team got after that inflation mitigation. We had to raise prices. Remember, we were constrained from raising prices during the pandemic because a lot of our contracts were locked in for 3 to 4 years. So it took us some time to raise those prices. But then we also got to work with the underlying costs. And some of those costs, especially international freight, started to recede. And so now we've got the margins in the right spot, and where now we can now go and focus on growing our Cardinal branded product.
Well, that's what
about
the Cardinal Health brand.
Portfolio.
See, Cardinal Health brand revenue 3% overall for the year, 4% in the U.S. Couldn't that double?
Well, our guidance is for 3 to 5% growth this next year. So we need just a little bit more growth than market. Low single digit type of market. That's what this guidance is based on. And even with that somewhat balanced growth prospects, given the carryover benefit of inflation mitigation, that gets us to the $90 million fiscal 24 growth to $175 million. So a near doubling of our profit next year by carrying over that piece and then growing our business just a little bit above market. Longer term, we would expect that to continue to be solid growth.
Okay, so CVS, the business that you have, seems incredibly good. You have a joint venture with them. Tell us about that, because that seems, again, meaningful to the earnings next year.
Well, so we have 2 joint ventures with CVS. And so we have a long-standing, we're about ready to celebrate our 10-year anniversary with Red Oak Sourcing, where we've worked with them on the generic side of the business. And so if you think about what that business has done, it's taken branded products and worked through with our manufacturer partners to find alternatives for our customers and ultimately value for the patients. This Avron joint venture I think you're referring to is the more recent announcement that we've had. And it's a similar concept with specialty products. So these are more complex products, more complex molecular products. And that is now going towards biosimilars. And a similar concept where we're able to bring more value to our customers and ultimately to patients to help them get greater access to these very costly therapeutics in a much more affordable way.
And now, last question, I need to know what you think about what the government's trying to do. Frankly, to Merck, to J&J, to me, I look at them as companies, but they're trying to help pricing. But to me, I look at it and I think, well, I don't know, our country is a fount of origination. I don't want to lose that. But the government's determined to get prices down. What's it mean for your industry?
Yeah, so we love innovation and we love affordability.
Right.
So we think it's important that patients have access to affordability, right? Because that drives the volume that's important for a distributor like us. And we need the volume to be competitive, to have scale, and to be able to drive down the costs in our business. But we also get that there has to be innovation. When you think about, obviously the phrase of the day are the GLP-1s. That's driving a lot of volume in the space. That drives up a lot of volume for our distribution centers, allows us to be more efficient throughout the network. So no matter where that innovation comes from, that's important to the current and the future part of our business. And it is important that we continue to have incentives to facilitate innovation. So that's the balance we're always looking for.
Yeah, well, you're right. I mean, look, I don't want to, I'm a stock guy, but affordability is the way we have to help 350 million Americans. So anyway, I want to thank you, Jason. Again, monumental quarter that I did not, when I saw your come, I said, uh-oh, but then, the quarter's real good. And congratulations on a great job.
Real good quarter. Real good quarter and a great plan ahead.
It was good. That's Jason Holler, CEO of Cardinal Health. Guys, they threw everything at this thing. The kitchen sink, and it didn't matter. It kept ticking. Mad Money is back after the break.
Coming up, not that Powell. Cramer gets laser focused on an industrial player that's been hot. More next.
All right, you'll love this, suggested by a viewer, of course. Normally at this point in the business cycle, you want to load up on the industrials because their earnings surge once the Federal Reserve starts cutting rates. Remember, we got that thing on Friday. Maybe give us a little insight. Lately, though, the market's fallen in love with a particular kind of industrial. These are still smokestack stocks, don't get me wrong, but they've also got powerful secular growth drivers, meaning they can win even if the Fed doesn't hit the accelerator on the economy. I think the buyers are right, which is why I spent last week highlighting Cummins, Dover, Eaton, Hubbell, and Parker Hannifin. We call them the new industrials because they're more like a group of old dogs that have learned some new tricks. Tonight, I got a smaller one, falls with the same category. It's called Powell Industries. This thing's been around since 1947. It came public decades ago. But the stock caught my attention over the past couple of years as it pole vaulted from $20 in late September of 2022 all the way to $171 today. You know what? That's a gain of more than 700%. Okay, so it's not what I talked about at the top of the show, Google, but I'll take it. What the heck does this company do, and how did its stock manage to catch fire like this? More important, can it keep running once the Fed starts blessing us with rate cuts? Okay, let's start with the basics. Powell makes custom-engineered equipment that distributes, controls, and monitors the flow of electricity, while also providing protection to all sorts of electrically powered hardware like motors, transformers. They're a key part of the electric equipment food chain, just like Eaton or Hubbell. Traditionally, Powell's business has been geared toward the oil and gas industry. Their systems help distribute power at oil and gas production sites, including offshore drilling rigs, and they also go into all kinds of refining facilities, pipelines, and liquefied natural gas export terminals. If you want to know why the stock languished from 2014 through late 2022, well, it's all about their oil and gas exposure. Even now, the fossil fuel industry accounted for 59% of the Powell's sales year to date. But the stock's spectacular breakout over the past couple of years has been driven by Powell's success in new end markets, namely utilities, transportation, like light rail, metals and mining, pulp and paper, and of course, the data center. Again, that's reminiscent of exactly what happened with Eaton and Hubbell, which I pounded the table on just last week. So everything really came together for Powell Industries last year with these new businesses generating tremendous growth. After 4 years where the company's revenue was stuck in the $500 million range, Powell put up 31% revenue growth in 2023 for total sales of just under $700 million. Meanwhile, their earnings per share nearly quadrupled. In 2022, they made $1.15 per share. Last year, they earned $4.50 per share. It's like hitting a lottery. In the 2023 annual report, CEO Brett Cope described his company as being, I'm going to quote this, right place at the right time. He went on to explain that Powell's strong track record in oil and gas has set them up to be, quote, a supplier of choice for critical electrical infrastructure that supports the most complex industrial applications, end quote. Basically, if their equipment can handle the petrochemical business, it handled utilities, especially utilities near the Gulf Coast, where so many of the petrochemical customers are located. Cope also mentioned data centers, electric vehicles, and semiconductors. They put it all together, and you can understand how Powell orders grew by 94% last year. Backlog increased by 118% to $1.293 billion. And that's the first time their backlog ever crossed the $1 billion mark. Now, those were insane numbers. Yet Wall Street still underestimated this company coming into the 2024 fiscal year, allowing them to repeatedly blow away the numbers. It's like the old days when companies were smaller, the mid-cap going to large cap. When Powell reported at the end of January, they posted 53% revenue growth, and they earned $1.98 per share. Now, the analysts were only looking for 84 cents. Yes, that's right. They more than doubled the analyst consensus. That's extraordinary. When Powell reported again in early May, we got another monster revenue beat, a staggering 97-cent earnings beat off a $1.78 basis. Again, that's an upside surprise of almost comical proportions, frankly. Most recently, Powell delivered yet another stunning quarter at the end of July, much higher than expected revenue, with the company earning $3.79 per share. Wall Street only expected $2.16. No wonder the stock's more than doubled in the past 7 months. These beats are extraordinary. Now, there are two big reasons why Powell can keep smashing the estimates like this. One, it's a great company that's firing on all cylinders, even cylinders we didn't even know exist. Two, more importantly, this company is lightly covered by Wall Street. I like that. In fact, only two fairly obscure firms even cover the stock at all. Kansas City Capital Associates, which, no shade, I've never heard of them. And then Sidoti Company. Neither firm seems to appreciate Powell's newfound earnings potential. That doesn't bother me. I just wish I'd recommended this thing a year ago, because lightly covered stocks can become huge speculative winners precisely because they're still fairly undiscovered. And look, until more analysts start following this thing, I think it could have more upside, although, of course, it gets bigger. There'll be some analysts who do cover from major firms. Now, I know it's a crazy thing to say about a stock that's already up more than 700% from its late 2022 lows. But to be completely honest, I mean, this thing is still underappreciated up here. If you look at the chart, you can see that Powell made a huge move higher from the beginning of the year through the end of May. But since then, it's pulled back. I mean, this might be the opportunity here. Even after rebounding in recent weeks, the stock's basically even with where it was trading in March. That means you're getting the last two colossal earnings beat for free here. That shouldn't be. Plus, you're not buying Powell at its highs. At its current price of $171, the stock remains down about 18% from its all-time high at the end of May. A lot of the industrials that we talked about have had similar compression. But the main reason I think Powell's a bargain is simply that the darn thing sells for just 14 times this year's earnings estimates. To me, that's lunacy. If we learned anything from the last couple of years, the estimates for this company tend to be way too low, so I bet it looks cheap in retrospect. That's what I say about, I'll remember about NVIDIA all the time. In retrospect, it's cheap. On top of that, if it doesn't hurt that Powell's got a pristine balance sheet, zero debt, none whatsoever. In fact, this is a $2 billion enterprise with nearly $400 billion in cash and short-term investments. When you back out the cash, the stock's only trading at 12 times this year's numbers. So here's the bottom line on this incredibly exciting, dull company. I know, impossible, but this one has it. Powell Industries is an excellent, under-the-radar industrial one that feels reminiscent of Eaton and Hubble a long time ago. The kind of modernizing industrial that I think can work best here. The difference, Powell's much smaller, which is why its stock can rally 700% in less than 2 years. Normally, I tell you not to chase, but given that this thing's pulled back substantially from its highs, I think you can buy it right here, right now. You know I'm a believer in J. Powell, right, Fitchy? Now you can count on me as a believer in Powell Industries, especially after Wall Street finally wakes up to the greatness of the story. Let's take some calls because I'm all fired up. I want to start with Ken in Kentucky. Ken.
Jim, how you doing? I'm a founding club member, and it's always a pleasure to talk to you, sir.
Ken, you just made my day. I spent a lot of time with some club members this weekend, and they just make me feel terrific, and I thank you for doing the same. How can I help?
Well, you need to come to the Cincinnati area so we can talk to you personally. But
well, that's Sarah Eisen's area. If she invites me, I'll go. I don't want to intrude on Sarah's kind of, like there's her region.
Yeah, it is her territory. But hey, listen, a family member asked me to look over her portfolio, and she had a stock in there that I don't think I've ever heard you mention it, and I've been following you since your radio show days. So,
oh wow.
Could you please opine a little on Steel Dynamics for me?
Okay, Steel Dynamics is a really, really good company, but we're dealing with a wave of dumping of steel by China that's coming through Mexico, and we're not enforcing it. And that's bringing down Steel Dynamics and Nucor. They are the two best in the industry, so it's tough to watch. I can't endorse it here because of what's happening, even though it's very cheap. I don't like what's happening below the border. Let's go to, thank you for the kind words. Let's go to Michael in Wisconsin. Michael.
Booyah, Jim from Wisconsin.
Excellent. Booyah.
Hey, the company called United Rentals. I know nothing about the rental market, but they've been doing very well recently. And I'm just wondering if I should, if we miss the high, or should I wait?
No, first of all, it's way off its high. It's up 25% for the year, though. But the reason why this company's working is when you read all the infrastructure that's being done in this country, you know that not everybody can go out and buy things. A lot of stuff is just rent, and they do a lot of stuff. I mean, they are everywhere. And I used to like the stock in the 200s and 300s. They used to come on air, and I thought that they were brilliant. I've not seen them in a long time, but they're still very brilliant. You've got a winner there, and you are I. All right, listen to me. Powell Industries is a fantastic under-the-radar industrial, and given where it pulled back to, I think this is the time to buy. Much more Mad Money, including my exclusive with Palo Alto, fresh off its stunning earnings report. Wait, we got to learn more about that. And is the stock of Estee Lauder in need of a revitalizing cream? I'm focusing on the company for today's report, and this is a tough piece, by the way. And, of course, all your calls, rapid fire, in tonight's edition of the Lightning Round. So stay with Cramer. When Palo Alto Networks reported back in February, the guidance was considered dismal. Stock plunged from the 360s to the 260s in a single day. But after speaking to CEO Nikesh Arora, what did I do? I told you to stick with it, maybe do some buying we did for the Chapel Trust, because the future's bright for this best-of-breed cybersecurity play. Sure enough, since then, the stock's been a juggernaut. Got this one right, closing at 343 today, and now it's rallying after hours trading. Palo Alto reported a strong top and bottom line beat with very encouraging guidance for the 2025 fiscal year, which already started. Don't take it from me. Let's check in with Nikesh Arora, the bankable chairman and CEO of Palo Alto Networks. Find out more about the quarter. Mr. Arora, welcome back to Mad Money.
Thank you for having me, Jim.
Nikesh, when you were on a couple of quarters ago, you introduced a concept called platformization. Immediately, the wags told me that was just a cover-up. He doesn't really have anything. He's just trying to snow you, Jim. In fact, don't we all wish that you had done platformization a lot earlier?
You know, Jim, I'm glad you're able to say that word without a hiccup because we're trying to get it in everybody's lexicon. Look, this is going to be how we're going to achieve our target of getting to $15 billion as the first pure-play cybersecurity company. And I have to say, as I said, I wish I'd done it earlier. One of my one of my prior bosses said to me, I wish I had executed my good ideas faster. So I feel the same way. I wish I'd done it earlier. Really excited by the pace of platformization, excited about the conversations we're having, and excited about the deals we delivered this quarter.
Well, it seems like we had been talking about the idea that it was hard to show a return on investment on something, particularly because, like, in cybersecurity, you don't want to have to shut everybody down. But the fact was that you were able to demonstrate more, let's say, a better use of a company's capital with platformization than just buying one product and stringing it up with others.
Well, I think, Jim, it's funny, like all of us have seen this happen, like, when Salesforce was born or Oracle Financials, we took a bunch of disparate systems and we put them together and called it the sales CRM platform or the supply chain platform. Now it's time for a cybersecurity platform. Now, I will tell you one thing. It doesn't matter whose platform you buy. You can't go back. You can't go back to point solutions and start stitching them. It's like a one-way street. Once you come this way, there's no going back. So our incentive is when we have the technological advantage, the platform, we got to get ahead of this. We got to move fast. We got to get our customers onboarded with this, which allows us to win the long-term game.
Well, we also need to get the analysts on board. For instance, I remember when Mark Benioff told me, listen, from Salesforce, we're doing a platform, and basically you better understand its remaining performance obligations. That's how we're going to do it. Yes. It killed his stock, but he did not care. You have said, look, let's switch to something that makes it so it's easier to understand how well we're doing, which is remaining performance obligations. How was that for the quarter?
Well, we grew 20%, Jim. And I've been on your show the last 4 quarters and telling you that billings is a broken metric. And we went and canvassed our shareholders. We talked to people like yourself and said, look, the real representation of our business is like other platform companies have shared. It's ARR and RPO. Adobe uses that. ServiceNow uses that. Salesforce uses that. Workday uses that. It's time we stepped up and started doing that for ourselves because we are actually now in the platform business, and that's the better metric to measure the success, both short-term and long-term for a platform company.
Absolutely. Now, I want to talk about CrowdStrike for a second. They're a competitor. They're a good competitor, and they're someone, by the way, that you have never said a bad word to me about. You are a competitive person yourself. But the fact is, they did make a mistake. And it's a mistake that there by the grace of God. Other people could have made it. But your system apparently you feel has a better fail-safe mechanism, or the way you would roll out something's got more of a fail-safe?
Yes, as I've said publicly, Jim, it's unfortunate it happened to them, and I think George and his team did a phenomenal job in trying to remedy the situation because it's important for the credibility of the cybersecurity industry that we maintain the trust, and he did. I think they could have done a better job of rolling out the changes. We do not do it the same way. We would never deploy something to tens of millions of customers in under an hour. We use a cohort of 1%, test it to make sure we have a representative sample, that if anything happens, we know what happened, so we can roll it back for those 1%, and then we do it in a phased manner. Not only that, we allow our customers to control the ability to do the phased rollout, so in case somebody has a mission-critical operation, they prefer not to do it during rush hour or busy hour, they could do it at a time when they have more downtime. So that way we're different. But other than that, I think we all deploy similar cybersecurity products.
But have you been able to... I know you're not a turkey vulture coming after a dead carrot. It's not that. But have you been able to capitalize off of it in the sense that, or has it been too soon? Maybe people are so buried they haven't been able to come in and call you and say, listen, we need your help.
Well, look, all that happened was our customers were busy remediating the problem. In fact, we had to be very creative now in making sure our deals got through because the last 2 weeks of our quarter as well. But I think the customers appreciated that we were there to help if you wanted help. The customers would like to talk about options that Palo Alto offers in a similar category. So we're seeing more conversation with customers, but we're not chasing it in such a way that they're bad, we're good. We're saying we're also good, test it out, give us an opportunity to deliver the capability. And, really coupled with our XIM capability, our XDR and XIM capability, which kind of is in the same sweet spot as CrowdStrike is, we're seeing momentum. As we showed, we've seen tremendous momentum in XIM.
Did you have yourself a chill, the idea that perhaps this is the way that a cyber terrorist get a little, didn't realize could shut down the system so quickly? I know Apple told me, look, we could have stopped it if we were the default choice. I mean, is it possible that, well, you know what, hey, they didn't get shut down. But do you think that this is a recipe for what could go wrong?
I think, Jim, what this is all showing us again and again is we've been operating a sort of a passive legacy, take your time environment, but the whole world is getting so much more interconnected. Whether you look at what happened in the healthcare industry, or look at in the car dealership industry, those are other ways that those systems got shut down because bad actors got in the middle of them. So yes, the world is telling you that you have to have more real-time security. You have to be able to find the problem, fix it in short order. That's why we say, get off the old legacy systems, get onto newer platforms, start protecting yourself in real time. So it's all sort of fitting the narrative that we want our customers to go towards. They just need to step up and do what they need to do.
All right. Now, one other thing that I thought was really terrific, a $500 million share repurchase. I mean, once again, there are a lot of things that happen that you said would happen. And I wish people could, I mean, look, you don't tell me any of this information, but I wish people would understand the confidence that you inspire by going and putting money where your mouth is. $500 million is not chump change. This is something you've got to keep.
Well, it's actually $1 billion. We're at 500 million. We already have a $500 million.
You already have one. But what I think that people don't seem to understand is you're hoping that if they want to sell it, go ahead. If they want to sell it at $340, you'll buy it.
Well, Jim, we generated $3+ billion of free cash flow. We're basically a debt-free company with almost $7+ billion of cash on the balance sheet, and we generate $3 to $4 billion a year. So we got to start figuring out ways to provide a return to our investors in the cash, and part of that is to do some share buybacks, and part of that is to be opportunistic to see how the industry evolves. Because, as I've said, cybersecurity is the most innovative industry in the world, so you have to keep your powder dry.
Well, I also didn't even go over what you've been doing AI and not what you're doing with IBM. These are all very big initiatives that you have.
Yes, Jim. Well, on AI, we're very excited. We crossed $200 million in ARR in AI, real AI, selling products to our customers. This is not ideas, thoughts, things we're trying. We actually sold $200 million worth of ARR into our customer base across all the stuff we do in AI. IBM, really, really excited about the deal, and really excited about what Arvind and I have been able to pull off. I think all the IBM customers are going to be delighted with our XIM product. I'm looking forward to that deal closing and converting a lot of those QRoC customers to Palo Alto.
Well, look, I'm a believer in platformization. Maybe others will join us. Since you taught me, I better learn it, and I have, and it's made our viewers a lot of money. I want to thank Nikesh Arora, Chairman and CEO of Palo Alto Networks, PANW. Thank you, Nikesh. Great to see you.
Thank you very much, Jim.
Absolutely.
Thank you.
Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast-fire lightning round is next.
It's time for the light round quiz. Remember, that's for a rapid phone line. Just saying, I talking about my bite self. Just put it in the close square to my step. Please, even play this out. And then the lightning round is over. Are you ready, Skate Dad? Time for the light round quiz. Let's start with Dave in Illinois. Dave!
Dr. Cramer, my good mad friend, I want to issue this warning to Eagles fans and the rest of the NFL. Beware of my Chicago Bears.
What is, you got a team there in Chicago? What's that? Are you like the White Sox? I know you got a lot of third baseball team. I don't know. Hey, Dave, but maybe you got like something in Winnetka. You know what I mean? Anyway, what are you up to, Dave?
Holy cow.
Dave, you had a chance to talk about the tomato sauce. You had a chance to tomato sauce me, and you went Eagles. Tomato sauce, Eagles. Come on, Dave.
Jim, today I want to talk about a dog. No, not Marley or Ragu, but rather Datadog. This $40 billion company recently reported revenue and earnings beats and raised their guidance. Late May, you said in the lightning round, we should wait for Salesforce to report first. But, Jim, I'm impatient. So is DDOG
Dave, this is because you're so good. I got to tell you, Datadog is a hugely fabulous company. And there were people who were trying to buy it for $20 billion before it ever came public. My problem is that it's just the definition of enterprise software, which is the kind of analytics that tells you how your company's doing. There's too many people in that business, Dave, so I am going to reiterate, I don't trust it yet, but it is a very good company. And thank you for the, thanks. Let's go to Barry in California. Barry.
Jimmy, booyah, baby. Yo, I love your platform. Hey, my daily goal has been to make $1,000 a day since I've been dapping it up with Travel Trust. I've been able to double that, but I could lose $2,000 a day as well, Jimmy. Jimmy, KKR, should I add to it or should I dump it?
It's one of the best run companies in the world. It just has been, it was a pleasure once. I've been able to meet the CEO, just sit next to him at a dinner. I mean, the guy's like dynamite, and I think it's a really great company. Let's go to Sanjeev in Texas. Sanjeev.
Hi, booyah, Jim. I have to say, I wanted to first off say thank you so much for being not only great at stock market analysis, but you've been a wonderful teacher. I'm grateful that you've made my kids interested in learning about stocks. I mean, you've made it fun for them, and I really appreciate the fact that you're a great teacher.
Oh, thanks, man. And younger people, I'm trying to get them in. I'm trying to get them now so they catch the 7,000% Google trade. How can I help you?
So the stock that I want to kind of back up the Brinks truck on is NextEra Energy Partners.
Big dividend, not sure about why we can buy it other than a big dividend. I'm afraid of that. I'm sorry. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer went shopping for cosmetics, but learned a valuable lesson along the way. You can't make it up. Mad Money will be right back.
What can I say about Estee Lauder? A couple of years ago, when it was already a horribly underperforming holding in my travel trust, I did a little experiment to figure out why. I go into Target for the Ulta Beauty Cosmetics section in order to get some makeup for my investing club Zoom calls while I was in Florida. I don't like to miss our 10/20 program with Jeff Marks every day, including vacation. Now, look, I'm not really a cosmetics guy. Normally this is not my department. But I saw the expensive stuff from Estee Lauder alongside the much cheaper stuff from ELF, frequent guest on the show. The bottles look pretty similar. But the price? We're talking about a fraction of what I would have paid for the Estee Lauder brand. Given that it's a Zoom call, I went for the cheaper stuff. I asked if the makeup looked fine to everybody, and everybody said yes. Nobody, including my wife, seemed to notice. It got me thinking, how about a little hijinks? So when we got back from Florida, I put the ELF makeup in my wife's makeup cabinet. She's been hardcore Estee Lauder forever. I made sure the bottle was turned around so she couldn't see the ELF label. Kind of called a blind taste test. I made sure I was nearby when she put it on. She had no idea it was ELF. It didn't feel any different or look any different. When I told her it was ELF, she said, "What a bargain. It looks the same." I bring this up because this morning Estee Lauder reported as usual was better than expected, but only because management always sets a real low bar. As usual, they gave you terrible forecasts. Not as usual. Longtime CEO Fabrizio Freda announced his retirement. It's been a rough ride for this very serious 66-year-old executive. He took Estee Lauder to incredible heights, but then he presided over what I can only call a disastrous decline in earnings and therefore the share price. Meanwhile, ELF Beauty, run by the scrappy Taranga Min, has become a powerhouse of brands promoted in stealth ways with a hefty presence on the internet. He embraces cheaper channels, Ulta for brick and mortar, as well as Amazon, TikTok for advertising, of course, direct-to-consumer too. All trends that Estee Lauder took much longer to embrace. But the real blind side's here with China and travel. These were the most reliable channels for Lauder until they were hurt so badly in China during the pandemic, and then they never came back. Never came back. Of course, not alone. Nike, LVMH, Procter & Gamble, Starbucks, Marriott, Burberry, Richemont, InBev, L'Oreal, they all misjudged. Although Estee Lauder had the double whammy of the travel channel, which truly got crushed. People just aren't buying fancy makeup in airports like they used to, and again, it hasn't come back. ELF escaped that fate because they weren't relying on these areas. The stocks tell the full story. If you go back to the beginning of 2022, Estee Lauder was at $370. Today, it's below $93. Meanwhile, ELF has run from $25 to $160 over the same period. I should have bought the one with the F right at the end of it. I think Estee Lauder got caught in the same consumer packaged good dilemma that's afflicted the whole industry. The company wanted to maintain its high prices in order to protect margins in an era where that strategy may no longer work. While Lauder unveiled a less expensive brand called The Ordinary, I think it was actually too little too late. Freda has a little less than a year to go as CEO, so we blew out of the stock for the travel trust. It was a hefty loss. Hey, we played with an open hand. It's brutal. How bad? Let me quote Gordon Haskett, a brokerage house with a piece today entitled, quote, "I know it was you, Freda, you broke my heart," end quote, which I'd argue is the perfect Godfather 2 reference. The release said the board has well advanced the succession planning process with many highly qualified candidates. Still, Freda will remain as CEO until June of next year. The analyst at Gordon Haskett notes, and I quote, "A well-functioning board shouldn't need 10 months to make a decision. Of course, the EL board is anything but well-functioning," end quote. If anything, I think he's putting it lightly. What I was hoping for, the announcement of a new CEO like Starbucks, simply didn't happen. Instead, we got still one more horrendous forecast and a huge number cut. Now, I can't honestly say that Freda really did break my heart, because that's not how this business works. I made the mistake. I believed the ship could be ready. It was on me. So we took our beating from the charitable trust and we went into the doghouse. Sad for Estee Lauder, but brutal for us. The moral of the story, like with Starbucks, I thought value, well, I thought it was there. Maybe in the end there will be, but you know what? It's going to be made without me. I'm done breaking my own heart. Let someone else make that money. It's too painful for me. It's not worth the angst of being an Estee Lauder shareholder anymore. I like to say there's always a bull market somewhere. I promise I'll try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.